Retail sentiment has soured as SoFi's stock price retreated double digits from its recent highs. To the casual observer, this looks like a failing fintech trap, a company unable to sustain its momentum. But on institutional desks, the perspective is different. While the public sells, professional capital is treating this price action as a window to accumulate shares, quietly moving into the stock before the next cycle begins. This disconnect between price and performance is driven by 4 specific catalysts that the broader market is currently overlooking. Pay close attention to reason number 4. It involves a shift in how SoFi accounts for its billions in revenue, a change that is largely invisible to those only looking at the top-line numbers. Understanding these factors now provides an information advantage, while the market remains focused on short-term volatility. Here is why the narrative is shifting. Reason number 1 is the membership flywheel. The common public perception of SoFi as a niche student loan provider ignores their massive expansion into integrated financial services. Like Amazon's tech stack, SoFi owns the underlying infrastructure. Through Galileo, they provide digital plumbing for global fintechs. In Q1 2026, this network supported 14.7 million members, utilizing 22 million products, creating a massive, scaling recurring revenue stream. This brings us to reason number 2, GAAP profitability. For years, the bear case built on the fact that SoFi burned cash to acquire customers. That era has ended. This chart isolates the Q1 2026 earnings, where adjusted net revenue reached $1.1 billion. More importantly, GAAP net income grew by 134% year-over-year to $167 million, proving the company can grow its bottom line. These metrics reflect a business model successfully transitioning from a high-growth startup into a highly profitable technology platform, even as the stock price remains artificially suppressed. Reason 3 centers on leadership. CEO Anthony Noto is signaling his confidence by consistently buying shares with his own capital during market pullbacks. He is leveraging a highly specific deposit-first strategy. By offering competitive interest rates, SoFi is capturing billions in direct deposits from high-earning users, moving away from traditional megabanks. This shift lowers their cost of capital significantly. Instead of borrowing expensive money to fund their business, they use these low-cost deposits to fuel lending, resulting in massive profit margins. Reason 4 is the broader macro setup. As the Federal Reserve signals a policy shift, any drop in interest rates will likely trigger a massive surge in loan and refinancing activity, placing SoFi directly in the center of the economic recovery. But the real driver is earnings quality. As this chart shows, virtually 100% of their adjusted net revenues have transitioned into pure cash revenue, eliminating reliance on accounting adjustments. This makes their primary income stream completely sustainable and predictable. Once the market recognizes this shift to high-margin cash flows, a violent re-rating of the stock price becomes a highly likely outcome. However, potential investors must weigh these catalysts against the inherent risks. SoFi remains a volatile growth stock, and its price performance is often decoupled from its business fundamentals during periods of market stress. If economic conditions deteriorate or if consumer credit defaults rise, the stock could experience significant downward pressure, regardless of its recent profitability. The investment case relies on asymmetric risk, the potential for significant upside in a company growing members at 35% and generating $1 billion a quarter in cash, while currently trading at a deep discount. The question is whether SoFi will emerge as the defining financial platform of the next decade, or if the current market skepticism is justified. Share your outlook in the comments below. For a deeper look at our internal valuation models and specific price targets, click the video on screen now. Subscribe to Streets to stay ahead of the next major market move. Information is the ultimate advantage.